Hi there, it's the Barrett again. We're going to get into CPA number 5, alternative investments, and ask the questions, are any of these asset classes and investments any good? We're going to be studying three of the what are called alternative investments, and there are others out there, but the main three that are out there are real estate, commodities, and hedge funds. So let's explore real estate first. Real estate is certainly a distinct and separate asset class. It has different tax characteristics than stocks and bonds. There are different risks present with real estate. It has a low correlation to stocks, generally speaking, but not a negative correlation in most market environments. It has different return expectations and different historical returns. There are different ways of investing in real estate. One of those is to own your home. Your residential real estate is basically having an interest, as we've discussed in class, in real estate. Most Americans who have exposure to real estate do that through their homes and also through stocks. Actually, 15 of the 500 stocks in the S&P 500 index are actually real estate investment trusts, which we'll talk about. You can also, of course, own an additional home or homes. I have one client who owns 5 homes. Farms, business real estate is very common and the like. And that's where you basically own this yourself in some way. There's no partners or anything like that. Then you can own them indirectly through pooled investment vehicles. These are the private type of that is usually limited liability companies. In some states, you might see limited partnerships. They're usually taxed as a partnership for tax purposes. And then there are real estate investment trusts, where basically a whole bunch of investors get together. It could be hundreds or even thousands of investors, and there are two types of those. One is publicly traded and not publicly traded. There's actually some other types, but we'll focus on these two right now. Most types of investors have some type of real estate allocation in their portfolio uh, other than just home ownership. Pension plans, both public and private, foundations, endowment plans, insurance companies, as you would expect, a lot of them own real estate in their portfolio. And public investment in real estate has grown over the years. Investable real estate as a percentage of the gross domestic product has increased over the last 20 years or so in the United States, Germany, Japan. Also increases, a big increase in China and India as well, and also Brazil. So there's a lot more opportunities to invest in publicly traded real estate investments. The risk and return of real estate is generally characterized as something between fixed income investments, bonds, and stocks. Typically, the standard deviation of real estate as an investment is lower. The returns tend to be lower than stocks, higher than bonds. But as we see, that can really fluctuate from decade to decade or even over very longer periods of time. So again, real assets, real estate, basically that you invest in, generally somewhere between equities and fixed income on the in terms of standard deviation and also in terms of their annualized rate of return. So, in some other countries, real estate has actually done better than just investing in the total stock market of those countries. France, for example, housing investing in housing has over the very long term, 1870 to 2015, has actually produced better returns than investing in stocks. Uh, then you go all the way down to the United States and you see housing as a form of real estate investment, 6% average annualized rate of return versus 8.4% for equities or stocks over this very, very long period. Uh, Since 1950, equities have performed real estate, if we look at an average of 16 countries and look at the geometric returns, you'll see that housing, which is basically the sample of real estate that's being looked at here, has rental income, and it also has capital gain, basically the appreciation in the price, yielding a total return in this full sample of 11.75%. That's pretty impressive. Equity or stocks have capital gain and dividend income. Capital gain is the increase in the share price over time, 8.75% uh, over this time period. That's the full sample, but if we look at after 1950, what we see is housing has a 12.94% total return, and the total return for stocks is about 10.32. So that actually looks like real estate is doing better, but that's across 16 countries, by the way. That's not just looking at the United States. Most of the returns from real estate come from rents received. I have one of my clients invested in basically vacant land 30, 40 years ago, and uh, land that has been turned into residential lots and has been sold slowly over time. Uh, those vacant lots really haven't done very well, even though they've been in an area of Florida that has boomed in terms of its investments. Uh, if you look at the rate of return on those lots, because you're paying taxes every year, you have to get the property mowed every now and then, and the like. If you look at the rate of return on that compared to the rate of return on stocks over that time period, there's really very no comparison. So if you are going to invest in real estate as an investment, uh, because most of the returns come from the rents received, you definitely want to have an income producing property. Real estate investment trust are a form of investing in real estate. Basically, you can invest in shares by putting your cash into REITs, real estate investment trust. You receive distributions from them every year. They use that cash with all the other investors' cash to go out and buy basically anything from shopping centers to office complexes to nursing homes to hospitals to office complexes, big skyscraper buildings, all kinds of different real estate investments, and those investments, of course, return real estate to that. Here's just a little sample of some of the many real estate investment trusts out there. There's over 1,000 real estate investment trusts out there that you can invest in. If we break that down by sector, we see retail 16.67%, residential, which would be apartments, for example, 14.24%, infrastructure, healthcare, offices, data centers, industrial diversified, broadly diversified, and then lodging and resort properties. Self storage is actually a pretty big thing, and then some other sectors as well. What makes a REIT different? Well, from a tax standpoint, and this is important, is 75% of the assets must be invested in real estate properties or mortgages or other REIT shares. Also included in that is government securities and cash. The reason being sometimes a REIT will raise money and not be able to deploy that immediately. So basically, you have to invest in real estate and mortgages, although you can hold cash until it's deployed and the like. 75% of the revenue must come from rents or mortgage payments, the interest income from mortgage payments, or gains. If you are running a REIT and you sell a property, it's gone up in value, you're going to have a capital gain on that. So those are basically the tax rules for that. All right. An additional 20% of the gross income must be from the above listed sources or other forms of income, such as dividends and interest from non real estate investment sources like bank deposit interest and the like. Right. And no more than 5% of the REIT's income must come from like service fees or some not investment in anything that's not related to real estate. Here's just a look at a real estate investment trust perspectives. This is the Choice Properties REIT. This is a 2018 prospectus. This is actually a real estate investment trust out of Canada. They were raising $2 billion at the time. Some of that could come from basically loans to the REIT, debt securities, and others would be units of ownership in the REIT. Choice Investment Choice Properties Real Estate Investment Trust made from time to time during the 25 months that this prospectus is open, all right, issue units of the REIT and also debt securities as well. And basically, this just goes and says what is the form of a REIT? It's actually a trust agreement. And this REIT has already been operating. It owns real estate. It owns 547 properties, commercial properties all around Canada and the like. And the laws of Canada relating to the REITs are very similar to the laws here in the United States. The beneficial interest of the REITs are basically divided into units, so you invest in units. And this REIT had 94 million units outstanding at the time that this prospectus was written. And this is just showing that the REITs have issued in the past a whole bunch of units, and it shows what the price per unit was at the time it was issued. So this REIT has been raising raising cash fairly consistently over time. And here's an annual report for Choice Properties from 2019, and we see a couple things here. The number of investment properties actually fell a little bit from 2018 to 2019, from 753 to 756. The occupancy rate was really high, 97.7%. The total assets of the REIT were $15 billion because everything on the financial statements is shown in thousands. The total liabilities is over $12 billion. It's very common for REITs to basically leverage the investors' investments to try to boost the returns. Basically, you go out and you issue debt securities or you get loans from banks, and they have a lot of debt to do that with. They have a lot of rental revenue. They had a net income in 2018, but they had a net loss in 2019. And that may have come because of the sales of some real estate. Perhaps they had losses on that real estate. And then they have what's called FFO. And we'll talk about that in just a minute, but you'll see that the payout ratio was 75% or higher, and the distribution per unit was about 74 cents per share. This is Canadian dollars, but if you think back, and this was trading about $12, $13 a share, you can see that the distribution of cash was, let's see, 7.4 divided by 13, somewhere in the neighborhood of about 6% or so.